Hey there, Stock Talk audience. Welcome back. We're doing something a little different today, something we think you'll find really valuable.
Yeah, this is a special deep dive just for you, our Stock Talk listeners.
And it's special because it actually comes from one of you. A listener sent us their sources and asked us to break them down.
That's right. So, to our listener who sent over these documents on Target's recent financial results, the Q1 2025 analysis. Thanks.
We really appreciate it. And our goal here is to go through everything you shared, cut through the noise and get straight to what really matters for you.
Exactly. We'll unpack the key numbers, figure out the story they're telling, and pull out the crucial insights from the report you gave us, kind of your shortcut guide to Target's quarter.
All right, let's dive in. Looking at the materials you sent, the headline for Target's Q1 2025 seems, well, kind of mixed.
It definitely is. The top line numbers, they really show the tough retail environment they're in right now. Your source points out net sales dropped 2.8%.
Okay, 2.8%, down to $23.8 billion from $24.5 billion last year.
Exactly. And comparable sales, that's always a key metric, right?
Yep.
That was also down.
How much?
Down 3.8%. That tells you a lot about, how customers were behaving this quarter.
Right. Does the analysis break that down? Like, why were comps down?
It does, yeah. The analysis you shared shows it was really two things happening. First, less foot traffic or clicks, I guess down 2.4%.
Okay, fewer shoppers?
And second, the folks who did shop spent a bit less per trip. Average transaction amount was down 1.4%.
So fewer people spending less. Not ideal.
Not ideal at all. Now, here's where the story gets really interesting, maybe a bit confusing if you just look at the headlines. The reported GAAP EPS
Right, the official profit number. What was that?
came in at $2.27. And if you just look at that compared to $2.03 last year, you'd think, hey, pretty good increase.
Okay, $2.27 versus $2.03. Looks solid on the surface, but you said confusing.
Yeah, because this is probably the most important detail in the documents you sent. That $2.27 number got a huge boost from something totally unrelated to selling things.
Oh, what was that?
Your source highlights a massive $593 million pre-tax gain. It came from settling some credit card lawsuits.
Wait, hold on. Nearly $600 million from a legal settlement.
Bingo. Not from selling detergent or T-shirts, just a one-time cash infusion from litigation.
Okay, that changes things.
Yeah.
So how do we see the real operational performance then?
That's where the adjusted EPS figure comes in. Your source thankfully provides this too, and it's crucial. It pulls out that massive one-time gain.
And what was the adjusted EPS?
$1.30.
Wow. Okay, $1.30 compared to the headline $2.27 and compared to last year's $2.03.
Yeah.
That's a completely different story.
It's a night and day difference, honestly, when you compare that $1.30 adjusted EPS to the $2.03 from Q1 last year.
Yeah.
It's a 35.9% decline.
Oof, minus 36%. Okay, that number shows the real pressure on the core business without the lawsuit money masking it.
Exactly. It shows the impact of those lower sales and, as we'll see, margin pressures hitting the actual profitability of running the stores and the website. That context is everything here.
It's absolutely vital. Okay, so let's dig into those sales declines. Where did they feel the pain most, based on the category breakdown you shared?
Sure. Looking at the different departments, it was definitely a mixed bag. Food and beverage, which is their biggest chunk of sales, almost a quarter.
Yeah, how did that do?
It held up pretty well. I actually saw slight growth, plus 0.8%.
Okay, so people still hitting Target for groceries and essentials.
Yeah.
That makes sense. A good anchor.
It is, but the more, discretionary categories, that's where you saw the weakness. Household essentials down 4.2%. Apparel and accessories down 4.8%. Hard lines like electronics and sporting goods down 2.7%.
And what about home goods? That often feels like a bellwether for consumer confidence.
You nailed it. Home furnishings and decor took the biggest hit, down a whopping 8.5%.
Minus 8.5%. Wow, that really screams people are cutting back on non-essentials, doesn't it? Like new furniture or decor is probably getting pushed off.
It certainly fits that narrative. When money gets tight, those bigger ticket home items are often the first to go. Interestingly, beauty was pretty resilient.
Oh, yeah. How did beauty do?
Down just 0.6%, so basically flat. It continues to be a category that draws people in.
Right. But even within apparel, which was down overall, your sources mentioned something interesting. A bright spot.
Yes. The Kate Spade collaboration, the report you shared, called it out as their strongest designer partnership in a decade.
A whole decade. That's impressive.
It really is. It shows that even when a whole category is struggling, Target can still nail the execution on specific things like these designer collabs and create some real buzz, drive some traffic.
And they can still execute well on specific initiatives, even with the broader headwinds.
Seems like it. And that actually leads us nicely into another area where the report you shared shows some real strength.
Which is?
Digital and omni-channel. This is where Target just keeps crushing it, frankly. Their investments are really paying off.
Okay, how are the digital numbers?
Digital comparable sales grew a really strong 4.7%. Compare that to the overall comp decline of 3.8%.
Yeah, huge difference. Digital's pulling its weight and then some.
Absolutely. And digging deeper, the growth in same-day delivery services, the stuff linked to Target Circle 360 was just explosive.
How explain?
Over 35% growth. It shows customers really, really value that convenience, and that loyalty program seems to be working.
That's significant. And digital's becoming a bigger piece of the pie overall.
Yep. Digital penetration ticked up. It's now almost 20%, 19.8% of total sales, up from 18.3% last year.
And how are they fulfilling all those digital orders? Is it efficient?
Extremely efficient, according to your source. They're leaning heavily on their stores. Get this, 97.6% of all sales, including digital, were fulfilled by their stores.
Oh, 97.6%. So they're using their existing stores as mini fulfillment centers. That's smart.
It really leverages their physical footprint. Seems like a genuine competitive edge they're sharpening.
Okay, smart move. Let's loop back to the margins, though. We talked about the EPS hit, but what about operating margins?
Right. So the reported operating margin was 6.2%, but again, like with the EPS...
Let me guess, the litigation gain.
You got it. That gain boosted the reported number. The adjusted operating margin, which pulls out the gain, tells the real story. It was much lower, 3.7%.
3.7% adjusted. Okay, that definitely highlights the pressure. Why was the underlying gross margin lower? It dropped from 28.8% last year to 28.2% this year. What caused that?
The report you sent points to a few things. One big factor was higher markdowns.
So more discounting to move inventory? Competitive pressure?
Likely both. They probably had to clear out stuff and respond to what competitors were doing.
No.
Also, the costs tied to digital fulfillment went up.
So fulfilling those growing digital orders costs more.
It can, yeah. Plus, they mentioned some startup costs for new supply chain facilities they're building out.
Okay, so higher discounts, higher digital costs, and investment costs, all squeezing the gross margin.
Exactly. They did mention one positive offset.
Yeah.
Lower inventory shrink, so less loss from theft or damage, which is good operationally.
But not enough to overcome the other pressures.
Apparently not.
So given these underlying challenges shown by the adjusted numbers, what's management doing about it? Is there a plan mentioned in your sources?
Yes, there's a pretty significant move highlighted in your report. They've set up something called the Acceleration Office.
The Acceleration Office. Interesting name. Who's leading it? What's it supposed to do?
It's being led by Michael Fidelk, a senior exec. And the idea behind it, as presented in your materials, is to basically speed things up.
Speed what up?
Drive faster execution on their big strategic plans, make the company more agile, more responsive, and really push to get back to growth. It sounds like a direct response to these sluggish results.
So management isn't just sitting back. They're actively restructuring or reorganizing to try and be more nimble and execute better.
That's certainly how it's framed in the information you provided, a proactive internal step.
Okay. What about the overall financial health? Balance sheet, cash flow. Your sources touch on that.
Yeah, briefly. The balance sheet looks solid. $56 billion in assets, almost $3 billion in cash on hand.
So they have resources. And are they still returning cash to shareholders, dividends, buybacks?
Oh, yeah. Continued the dividend, paid out $510 million in Q1. And they bought back $251 million worth of shares. Still have a lot authorized for future buybacks, too, like $8.4 billion.
Okay, so shareholder returns are ongoing.
Yeah.
But what about the cash generated from the business? Operating cash flow.
Well, that's a pretty big drop. Down to $275 million from over $1.1 billion in the same quarter last year.
Oof. Why the big decrease?
Your source points to a couple of things. Changes in working capital, mainly higher inventory levels. They ended the quarter with $13 billion in inventory versus $11.7 billion last year.
Holding more inventory ties up cash. Maybe they expected better sales.
Could be. And they also kept spending on capital expenditures. CapEx was $790 million, investing in store remodels, supply chain tech, that kind of thing.
Right. So higher inventory, continued investment, Less cash from operations this quarter. Makes sense.
And that also impacts return on invested capital, ROIC. It dipped slightly, 15.1% versus 15.4% last year. But here's that theme again.
The litigation gain.
Yep. The report you sent specifically notes the gain boosted the reported ROIC by 1.4 percentage points. So the underlying return on their core business investments was actually weaker than 15.1%.
It really does keep popping up, masking the underlying trends. Okay, so what's the outlook? What are they telling investors to expect for the rest of the year based on this report?
They updated their guidance for the full fiscal year 2025, and it's definitely more cautious. They now expect sales to decline low single digits for the year.
Decline.
Yeah.
Didn't they previously expect flat to slight growth?
They did. So this is a downgrade. They're acknowledging this sales weakness might stick around.
Okay, more cautious on sales. What about the profit outlook, the EPS?
Well, again, two numbers. The GAAP EPS range for the year is $8 to $10. But remember, that includes the big Q1 litigation gain.
Right. What's the adjusted EPS guidance, excluding the gain?
That range is $7 to $9 for the full year.
$7 to $9 adjusted. That's still a pretty wide range, isn't it? $2 difference from bottom to top.
It is quite wide, yeah. That usually suggests management sees a fair bit of uncertainty ahead. Could be consumer behavior, could be competition, could be timing on their own initiatives. It's hard to predict precisely.
So uncertainty reflected in the guidance. What are their big priorities for the rest of the year, according to your source?
Your report lists a few key things. Execution excellence that ties back to the acceleration office. Continued digital growth. Focusing on operational efficiency, costs. And improving the guest experience.
Makes sense. And how did the CEO, Brian Cornell, frame the quarter in the materials you shared?
He acknowledged it was a tough environment, definitely highlighted the good stuff like digital and the collaborations, but he also explicitly said they are not satisfied with current performance.
Okay, so acknowledging the issues.
Yeah, and he mentioned seeing opportunities to move faster on their growth plans, which, again, lines up perfectly with launching that acceleration office. Seems like a clear message. We know we need to do better, faster.
Got it. So just to quickly recap the main risks and opportunities that kind of jump out from the materials you shared.
Sure. On the plus side, you've got that really strong digital momentum, the potential impact of this new acceleration office, the loyalty program strength, those successful collabs, and, a solid balance sheet.
Okay, those are the opportunities. And the risks clearly laid out in the report.
Big one is continued pressure on consumers, right? People being cautious with spending.
Yeah.
That leads to margin pressure from more markdowns, maybe higher fulfillment costs. Then there's the challenge of getting traffic back into the stores.
Which impacts efficiency.
Exactly. And then there's just the risk of execution. Can this acceleration office actually deliver the needed changes quickly enough? Plus, managing inventory and supply chain costs remain ongoing challenges.
Wow. Okay, we've really peeled back the layers here based on the documents you shared for Q1. It's definitely clear targets navigating a pretty tricky retail environment.
No doubt about it. We saw where their investments are really working. Digital, omni-channel, that's a clear strength, something to build on.
But the core business, yeah, especially store traffic and those non-essential categories, definitely facing some serious headwinds. And like we kept saying, that underlying picture, once you strip out the one-off gain.
Once you look at the adjusted numbers for EPS and margins, it shows the real operational pressure they're under.
Right. The headline numbers got that artificial boost, but getting back to real sustainable growth means fixing those core issues.
Precisely. And that's clearly why they're launching initiatives like this acceleration office. As detailed in your report, it's management saying, okay, we need to shake things up internally to tackle this.
Shows they recognize the problems. Now, as you said, it's about execution. So maybe here's a final thought for you to chew on based on everything we just went through from your sources. Target's making these proactive moves like the acceleration office. But the question is, can an internal initiative like that, even a well-intentioned one, really overcome these pretty strong external headwinds, cautious consumers, tough competition, and the internal issues we saw in those adjusted margins? Can it really get them back to the growth they want in this environment?
Yeah, that's the million-dollar question, isn't it? And maybe more practically for you, what specifically should you watch for in Target's next quarterly report? What would be the signs that these changes, this acceleration office, are actually starting to work?
Good point. Like, are comps stabilizing? Is store traffic improving?
Or are those adjusted margins starting to tick back up? Even slightly, maybe they narrow that wide EPS guidance range. Those might be the tangible clues.
Excellent points to watch for. The next report will definitely be telling. Well, this was a fantastic deep dive. Really appreciate you sharing those sources with us. Thank you again for sending them over and letting us break them down just for you.
Yeah, it was great. Digging into the details behind the headlines, that's what we aim to do here.
Absolutely. And to the rest of our Stock Talk audience, we hope you found this specific look into Target's results useful. And maybe it shows the value of, digging a bit deeper than the headlines.
Definitely. If you found this helpful, please make sure you hit that subscribe button for Stock Talk wherever you listen.
Subscribing means you won't miss our regular market talks or any future deep dives like this one.
And please, if you could take just a second, it really helps us out if you comment, give us a like, or share the show with someone who might find it useful.
That engagement truly supports the show and lets us do more of this kind of analysis for you.
We really appreciate you tuning in and being part of our Stock Talk community.
Until next time, keep digging into those numbers.